managers. So as far as my background is concerned, I'm a product of Delhi University only. I did my BCom honors in 1991, and I do not know how many of you are born at it. So you can take the line. You can start the line, right? Okay. So did my BCom honors, and I did my cost accountancy at that point of time only, and then I did my PG in finance and passed it in 1994. Then I started my career with a company called DLF Universal as a management trainee, and I worked for almost 8 years in the corporate sector, and simultaneously I was inclined towards teaching at that time because that was not a choice, that was just an interest, right? So I started teaching when I was a student itself of my post-graduation. So then gradually I got an opportunity to get into full-time teaching profession. So I joined in 2002, and since 2002 I'm in full-time teaching, right? And currently I'm working with one of the college in Uttar Pradesh and Azipad itself, and taking care of the management program. And my area of specialization is finance and accounts, right? So I'm here to teach you accounting for managers. Okay, so let me just see whether it starts working. Okay, give me a minute. And okay, before this starts, let me understand how many of you are from the non-commerce background? Okay, few of them, and rest of you are from. And how many of you are from the arts background, please? Very few of them, and majority of them you are from the commerce background, right? I believe you guys have studied this particular paper, accounting, many times, maybe from 11th to your graduation, right? It's almost 5 years you have studied this particular paper. So the non-commerce student, I'm sorry, yeah, thank you. Right. So this is one thing, like when I enter, I do not allow. Even he said that you should not allow. Even I don't allow people after I enter into the class, right? So, so the non-commerce student, this is new to you, right? And this 15 hours module would be a great learning. I hope so, and I am able to deliver it to you guys. But the commerce student, they will find it boring. Oh, fine, again accounting, right? And the same stuff, fundamentals of accounting, this and that, right? We have already studied, and why we have to study it again, right? But let me tell you, learning is always there. You have studied from another professor, you will study from from another professor. Maybe something new you will you will get, something I will also learn from you guys, right? Okay. So let us make it more this class more interactive, participative, and non-commerce student, don't take it that these commerce students they know a lot of things, right? We are here to learn right from each other. Why this is not working? Laptop चल भी रहा है, I don't know why. आपका हाँ मेरा ही पहले किसी और का था, पहले किसी और का लगा, आप तो रहे लेकिन स्क्रीन पे जाती है पता All right. So this is your syllabus, and which is divided into 5 units, right? Unit 1, Unit 2, 3, 4, and 5. And Unit 1 is more about the basics of accounting, right? And Unit 2 is about depreciation, inventory valuation, and Unit 3 is all about the presentation of the accounting information, and where we talk about the financial statement analysis, reporting, and what are the tools we use to analyze the performance of an organization. Unit 4 is about preparation of the cash flow statement, and the last one is more about responsibility accounting and objectives and methods. Sorry, please speak to the SL people. Right. Fine. This is the basic syllabus of your and this whole 5 units we have to cover it in 15 hours. Okay. So I'll be a bit fast, right? And but you will get the study material, everything, MCQs. And other question bank which will help you in understanding the subject. So let's start with the Unit 1. Now, why we study financial accounting? Let me tell you, it's just a simple formula. Simple reason is that we all are human beings and our memory is very limited. So we do not remember each and everything which is happening in our personal life as well as in our professional life. So when we talk about the company, there are a lot of business transactions taking place, right, on a daily basis. So for an accountant, for the accounts people, it is not possible to remember each and every business transaction, right? So that is the reason accounting came into picture, and the purpose of accounting is to record all the business transactions. That is the reason accounting has come into picture. Whether it is a small business transaction or a big business transaction, whatever small or big means in the terms of money, but it has to be recorded. It has to be recorded. That's the first important thing. Number one. Number two, when we record all these business transactions, we would like to know in last one financial year, right, what company has done. What is the turnover? What are the assets which have been added? What are the liabilities which the company has raised loan from bank or financial institution, right? And apart from that, they would also like to know at the end of the year whether it is worth doing business or not. Means whether the company is earning profit or not, right? So that is number two, to know actually the financial position of a company, to know actual profitability of a company or not at the end of the year. That's number two. Number three, company, they do business, and they do business to expand, they do business to grow, right? So the third most important reason of doing accounting is whatever we have done, the company has to take some decisions on that basis of that. Maybe company would like to expand their business, maybe the company would like to get into any other business, they would like to diversify, right? They may want to get into any kind of a venture, a joint venture, mergers, acquisition, right? So they have to take a lot of decisions, or maybe introducing a new product to the product line. Is it worth adding new product to the product line, right? Or maybe it is better to get rid of this product and because this product is not a profitable product. Clear? So there are a lot of you can say the company, they would like to analyze the performance of a company business, right? That is the reason, and they have to take a lot of decisions. That is why accounting is there. So that is the reason we study accounting. One, we record all the business transactions. Number two, we would like to know whether the company is earning profits or not at the end of the financial year. And number three, the company has to take a lot of decisions to grow their business. Clear? So, yes, okay, so moving down to the accounting definition, that's a very standard definition which you will find everywhere in the first chapter of the book. As per the American Institute of Certified Public Accountants, the accounting has been defined as that it is an art of recording, classifying, summarizing in a significant manner and in terms of money, transactions and events which are in part at least of a financial character and interpreting the results thereof. So there are 5 things which have been highlighted here. First, recording, classifying, summarizing in terms of money and interpreting. Now remember, these are the 5 functions of accounting. The first function of accounting is that you have to record. Now simultaneously I will be doing accounting also. There is some theory based on some practical thing, right? So when we say recording, right, recording here means where to record. Where to record. Now recording means that if there is what you call a journal, right? And what is a journal? Journal is the primary book where business transactions are recorded. Journal is the primary book. So how do we record a journal, the business transaction? By passing journal entries. So in journal entries are passed. Right? That is all what you have to take care of here. The journal entries are passed. Now, how to record the journal entries? That we will come later on, because there are certain rules, regulations, accounting rules and regulations are there. With the help of them, we record those business transactions, number 1. Number 2 is we have to classify them. So then another one is classification. Classification. Now, what is classification? A lot of business transactions are taking place in a company, in a business, right? Depending upon the size of the business. There's a pawn shop on the road. He's also doing business, right? So he has a, let's say, 10, 15, 20 odd business transactions on a particular day. And there's another giant company like Procter & Gamble, Larsen & Toubro, Hindustan Unilever, Reliance Industry, State Bank of India. They are doing crores of transactions maybe on a day, or thousands of transactions on a day, right? So when there are business transactions that are taking place, remember there are 2 things which will be affected. Like say for example, in the morning, coming here, you want to have bread, butter and omelette, for example. You went to the shop, right, and you bought bread, butter and eggs for yourself. You purchased them and you paid money. So 2 things happened, right? Something has come to you, something has gone out, right? So there are 2 things which will definitely be affected when any business transaction will take place. Is it okay?
Yes, sir.
You go to a shop, you want to buy, let's say, shirt for yourself. You bought shirt and you paid money. Today it's plastic money everywhere. Even I'm not carrying money in my pocket, right? So you have a debit card or a credit card. So for example, I don't have money in my bank account. So then my debit card is a useless card. But I have credit card with me and it has a credit limit. So I can go and buy anything without even paying anything. Right? So my banker is paying on my behalf.
Yeah.
Clear? Right? So again, the transaction has taken place. I have bought something, nothing has gone out from my pocket, but I am liable to pay to my bank. Absolutely clear. So that is what you call classification. When I say this, transactions are taking place. So every business transaction, 2 accounts or more than 2 accounts will be affected. Is it okay? So what we have to do, there are a lot of items. We call them items. We call them components. Now those components need to be classified. Right? Now when I say classification, their classification happen. What is this classification? We call them assets, we call them liabilities, we call them expenses, we call them revenue, or we also call them owner's equity. Now these are the, you can say, broad classification of the items, broad classification. Right? Now further, we can categorize, we can further classify them. What are the types of assets, let's say? What are the types of liabilities? What are the types of expenses? We can have it. Clear? Let's say for example, assets, we have fixed assets, right? We have current assets, and we have fictitious or intangible assets. The This is another category. Clear? Right? When we talk about liabilities, there are two types of liabilities. One is a long-term liability and another is a short-term liabilities. Clear? Expenses. There are two types of expenses, right? Broadly. One is a direct, another is a indirect expense. Well, I'm writing after so many years on chalkboard, right? So please bear with me. So, direct expense and indirect expense. And then we have a revenue and owner's equity. We will talk about all these items in detail later on. But remember, this is what you call classification. Whatever items, whatever accounts we are opening, right? They have to come under all these, in any of these, right? Clear? Third function of this is summarization. Summarization. What is summarization? It's something like, as a student, you have studied the whole year. You have studied the whole year. And you have given a lot of unit tests, surprise tests, your class participation and assignments. Now, at the end of the year, you get your report card. That is your academic report card. So whatever you have done, it has been summarized. Is it okay? Yes. Clear? So that is what you call summarization. Whatever we do in the business in the one financial year, I believe you know what is a financial year. Yes. It starts from 1st of April and it ends in 31st of March. Yes. And there is a calendar year which is from 1st of January to 31st of December. Clear? So summarization happened. What is summarization? Summarization means whatever we have done in a business in one financial year, it has to be summarized. Right? So how summarization takes place? We prepare financial statements. So summarization happens by preparing financial statements. It is a report card. It is a report card of it is a financial report card of a company. It is a financial report card of a company. Clear? Right? Fourth function is that in terms of money. Another function is in terms of money. Now let me tell you, when business takes place, there are a lot of business transactions taking place, right? So some of the transactions are of qualitative in nature, some of them are in quantitative in nature. Qualitative and quantitative. Now remember, qualitative information is like recorded in business transactions. For example, let's say COVID happened. There's a lot of companies, their turnover declined, their profits have declined. Now this is a qualitative information. They cannot, this information cannot be a part of your financial statement. No doubt, business has gone down, but business has gone down because of COVID. Right? But this is the qualitative information. Yeah. There's a fight between, let's say, finance manager and a marketing manager. A finance person is not releasing funds to brand or to promote the product. Right? So there's a fight. Because of that, the turnover has gone down. Now, this information you will never find in the financial statements. This is the qualitative information. Clear? Maybe the owner of a company, he was flying and the plane crashed and the owner died and the business has gone down. People are skeptical about what will happen to the business, right? Who will take care? Who will be the next you can say successor of this particular businessman? No doubt, it has affected the business. The business has gone down, or maybe it has affected badly. But this information is a qualitative information. So no qualitative information is, I am not saying that this should not be a part, but it is not reflected in financial statement. Is it okay? Yes, so all those business transactions which can be expressed in terms of money, all those business transactions which can be expressed in terms of money, they are shown in the financial statement, or they are considered, they are recorded. Is it okay? Yes. Right. And the last important thing is interpretation. Interpretation. Now what is interpretation? Now let me tell you, the companies are doing business. They are doing business for themselves. But at the end of the financial year, they have to get their financial statements audited. Audited is what? Investigation. Whatever we have done it as per the rules and regulations or not, as per the accounting principles or not, right? Okay, so those what you call is the, so they make it, but they do not make it for themselves. They make it for others. Who are those others? We call them users of accounting information. Now, who could be the users of accounting information? The people who have interest in that organization. It could be the management, it could be the owners, it could be the investors, it could be the banks, financial institution, students like you. Maybe you get a project, right, and you are working on that project. So you will be keen and interested to know the and study the financial statement of a company, right? So the last important function is that whatever summarization has happened, right, that has to be analyzed. That has to be interpreted, because this will help the management and owner to decide the future course of action of the business. What we have to do in the next financial year, what we have to do in the next 5 years, where we would like to take our company in the next 5 years from now, or maybe what should be our market share. Today our market share may be 7%, we would like to increase it to 8%, 9% next year. So all those decisions, they are depending upon summarization, and interpretation is important. Now how do we do interpretation? There are tools available. That is there in Unit 3 and Unit 4, where we prepare ratio analysis, we study ratio analysis, and we also study cash flow statement. That will help us in interpreting the business. Is it okay? Okay, sir. Clear? So, from the above definition, the following points are highlighted. Accounting discloses the nature and amount of income. This is what we have spoken about. Only the transactions of financial character are disclosed. This we have talked about. It is the art of summarizing business transactions. The economic activities carried out by the business are disclosed along with the financial condition. And the last is importance is laid on the communication of information to the persons who are there to make the decisions, important decisions for the company. Clear? Yes, right. Now let's move down to the next methods of accounting. 2 methods of accounting, right? Let me tell you, there is a single entry and there is a double entry. Normally single entry means that it says that business organization, if following the system, they prepare only cash book and personal accounts like debtors and creditors. Nothing is there, right? But let me tell you, if any company is following this single entry system method of accounting, then it is incomplete in itself. It is incomplete in itself. Why? Because 90% or maybe more than that of the business is today done on credit. It is not on cash. It is done on credit. So therefore, single entry system is not possible. And remember, we cannot prepare a trial balance. That I'll tell you after when we actually do the accounting part, right? Okay. Now let's move down to the double entry system. So single entry is clear. Single entry, there is only cash transactions, okay, and only personal accounts are considered. Credit transactions are not considered in single entry system. Therefore, it is not complete in itself. Right? It will not give a clear picture of the organization. It will not give you the true and fair picture of financial position of the company. Number one. Number two, it is not possible to prepare a trial balance, because if trial balance is not prepared, financial statement cannot be prepared. The accounts people, they know about it, the commerce people, right? Double entry system, it's very true. Like I said, you bought something, you gave something, right? For every business transaction, there is something will be debited, another will be credited. So there are 2 things which will happen, that is debit and credit. Yes. So one item will be debited, another item will be credited. Is it okay? So in all business transactions, remember, in all business transactions, debit will always be equal to credit. Yes. If you have 100 rupees in your pocket, the maximum outflow from your pocket will be 100 rupees. It cannot be 101 unless until you borrow. Clear? Until you borrow. Right? So remember this debit, it has to be equal to credit in all business transactions. ये हमेशा बराबर होंगे. Your right hand is equal to your left hand in all business transactions. That is what you call double entry. So what it says, it maintains the twofold effect of benefit giving and receiving, right? It means that the record of equal debit and equal credit is maintained. In India, business transactions are recorded considering double entry system, hence depicting the debit and credit of each and every business transaction. Clear? Clear?
Yes.
Okay. Well, objectives of accounting. Why we study this accounting as a subject, right? One, it depicts the profit and loss of a company, right, for a particular period of time. So we come to know about the profit and loss. Number two, it helps in maintaining the business transactions, recording the business transactions. Number two. Number three, it helps in depicting the true financial position or true, you can say profitability position, liquidity position of a company, solvency position of a company. Number three, like I said, liquidity position. It helps in management in making rational decisions, right? Decision making is only possible through this accounting. To fulfill the requirement of law, absolutely, because when we do business, we do not do business we cannot do it on our own. So there are rules and regulations. Those rules and regulations need to be considered. Considering those rules and regulations, the company has to do business. They have to maintain the books of accounts, right? And the next is to provide accounting information to its users. Like I said, the companies, they make financial statement not for themselves but for the users of accounting information. And there are many users for accounting information. That we will talk later on, right? And to disclose the credit worthiness of the business. This is again very important. Credit worthiness. Because I hope all of you know that everyone who is doing a business, even if your salary, your credit worthiness is very important. And how can we have a credit worthiness? Seeing your CIBIL score. Yes. Every individual who is a salaried one and who has taken a loan at one point of time, you have to have a CIBIL. And that is where we can see and analyze, okay fine, the credibility of this individual is good, the credibility of this individual is bad. Is it okay? Similarly, the company, what happened with the companies like, you can say, Enron, right, and then in India we saw that Tech Mahindra once at one point of time, it was in bad shape, right? Another one was Vijay Mallya, another one. There are a lot of companies whose accounting they have not done as per the rules and regulations, right? They committed some scams or frauds, right? And that is the reason. So law is important and credibility is important. No bank, no financial institution will give a loan to a company if their reputation is bad, if their image is bad, right? Or if they are defaulters. Clear? Right? So these are some objectives of accounting. Now everywhere we see that there is a process. Let me tell you, everywhere there is a process. Whether it is accounting, whether it is economics, whether it is statistics, whether it is, you can say, physics, chemistry, bio, right? There is a process. Everywhere it is a process-driven thing. Clear? So similarly, accounting information system, there is a process. What is the process is like? Input. Input is in the terms of business transactions and events. So whatever business transactions are taking place, right, those are, they are taken as an input. Is it okay?
Yes, sir.
If you want to have a, let's say, mango shake, the input is mango. Similarly, to have those business transactions recorded, to know the profitability position or the financial position of a company, we need to have a business transaction. Now, there the processing taking place. We have a business transaction, you need to process them. How do we process them? Considering those accounting rules and regulations. Is it okay? Clear? Right? Then we have an output. Output is in the form of the statement, financial statements, cash flow statement. They are the outputs. And then the last is the users. Who are the users? Like I said, bank, financial institutions, management, owner, creditors, private lenders, taxing authorities, researchers, scholars, media, all these are the users of accounting information. So accounting information as a system, there is a process, input, process, output and users. Is it okay? Clear? Okay. Now, accounting as an information source. Now, what it says is that accounting is to provide information to the users of accounting information so that they can take important, relevant decisions to grow their business. The accountants have to enhance the quality of the financial data and they have to make it understandable to the users of that accounting information, right? So, to achieve this, what is to be done? One, there are 4 factors which are to be considered to see that accounting information is meaningful. It is a source, it is an information source. And based on this, we will be able to take a rational decision. Is it okay?
Yes, sir.
For as an investor, if the company has done window dressing in their financial statement, window dressing का मतलब क्या था? साजो सजावट करना. Is it okay? In Hindi, we call it. Something you see, I'm not a good looking man, right? And I go to salon and get it done. And I'm now a handsome guy, right? So that is what we call a window dressing. So if you see a company from inside is not doing good, but window dressing is done and it is shown to the public, it is shown to the investors that company is doing very great. That is what we call window dressing. So what happened? This company, the accounting people, they have to have such information so that the people who have interest in the company, they are able to take the rational decision. First one is a reliable. Now the accounting information need to be reliable. It has to be true. It has to be correct, right? And free from all biasness. Clear? And error to depict the correct financial position of the company. That's the first important thing as an accountant. So maybe all of you may be joining any accounting firm and all that. You need to understand that you need to be ethical. Whatever you do in a company, in a business, right? Either you are an owner or whether you are on the side of this table or on that side, you need to be ethical, number one, right? So, reliable, relevance. Accounting information must be relevant and available on time. That is very important. Relevant information must help in proper predictions and decision making. So, it has to be relevant. All irrelevant information, all immaterial information should not be a part of financial statements. Is it okay? Clear? Third, comparable. Now, but that is something very important. If the information is not comparable, it is not possible to take the right decision. Or is it? No. For example, in my BCom honors first year, I scored, let's say, 58% in Delhi University. In the second year, I scored 62% in my BCom honors. So I will say, okay, fine, I have put in more effort. I have done great hard work. In my first year, I was second divisioner. Now in the second year, I am a first divisioner. Right? So I put in a lot of effort. Right? So my approach was good. And I became a bit relaxed in my final year. I said, okay, fine, now I know I am. And again, the percentage has dropped down and it went to 52. So I am a second divisioner holder. Right. So I'm comparing because that was my academic report card. Similarly, every company has a financial report card. Now, in this financial report card, what they do? They compare the current year figure with the previous year so that they can make the correct decision for their business. Right. So comparison is possible within the company, and there is a company to company analysis can be done. What is company to company analysis? Let's say, let me talk about, let's say you have auto sector, automobile. Now in that auto sector, you have many companies are there. Let's say Tata is there, Tata Motors, right? Maruti Suzuki is there, right? Okay, for example, if you have to put in money, right? What you will do? One, for example, I will see Tata Motors current year performance with the previous year performance. That is one thing.
Yes, sir.
This is what you call the another one comparison. Another comparison is that when I compare Tata Motors and Maruti Suzuki. Where to invest my money? So comparison is possible, should be possible. So accounting information need to be comparable with other time period as well as with other entities. Is it okay? Yes. Clear? This we will study when we will be studying ratio analysis. Another is understandable. Well, accountants or the companies, they do accounting, they do it for not, they make it and they make it for the users of accounting information. So who will be using those accounting information? That they need to be able to read it clearly, they need to be able to understand it easily. That's very important, right? So accounting information should be easily understandable so that proper financial decisions can be taken. That's very important. So these are the four, you can say accounting as an information source. They need to be reliable, they need to be relevant, they need to be comparable, and they need to be understandable. Is it okay? Yes. Clear? Okay. Now let's move down to some branches of accounting. Every tree has a branch. A mango tree, you will only have mangoes. On a banana tree, you will always have a banana. It has branches. So, but accounting, we have three branches. We have three accounting which we do. Now, what is in those three branches? One is a financial accounting, that is your subject, right? Another is what you call is a management accounting, which you will be studying in your second semester. Management accounting, because management accounting is purely decision making. Whatever you will study in management accounting, that will help you in deciding what is to be done in the business. What decisions you have to take in the business. Is it okay? Clear? For example, Hindustan Unilever. It is an FMCG company, fast moving consumer goods. Let's say one product line, they make soap, bathing soap. Now in bathing soap, they have a lot of fragrances are there. They have rose, sandalwood, lemon and all that. Now, the moment the company, they want to add one more fragrance in the product line, let's say musk they want to add. Okay? Now that decision, adding one product in a product line, it is not financial accounting matter. Yeah. It is not financial accounting matter. It is a management accounting matter, yes, where they will decide what should be my sales mix, what should be my product mix, whether to expand or whether not to expand. It's a 100-bed hospital. Should I add more 50 beds to my hospital or not? Are you getting my point or not? Is it okay? So that is what you call expansion. Any kind of an expansion, any kind of a diversification, you will study management accounting. Then the third one is the cost accounting. Now cost accounting is purely based on, like for example, whenever you buy any product, you see that batch number is there. Yes? Clear? So when we say batch number, and let's say there is a problem in a batch, let's say Tata Motors makes Nixon, and there's a batch, right? And there's some problem in the steering. So they will always, there's a news you will see in the newspaper, to find the people who have bought Nixon, right? And from this period to this period, because they know this is a batch number, there's a problem in steering, you can come back, you can go to the showroom and get your steering problem resolved. Yes, yes. So that's a batch. So when we do batch, when we do process, right? When we do job, costing, all this comes under cost accounting. So cost accounting basically talks about more about cost. What should be my cost? On the basis of cost, we fix the selling price. Is it okay? So cost accounting helps us in understanding the cost, means what should be my cost, how to prevent the cost, how to reduce the cost. So there we study a lot of cost things, right? So these are the three branches of accounting. Majorly, I would like to talk about the difference between financial accounting and management accounting. That's very important. Now, financial accounting is constrained by GAAP. Management accounting is not constrained by GAAP. What is GAAP? Generally accepted accounting principles. Generally accepted accounting principles. This we will be talking in further slides in detail. But remember, generally accepted accounting principle, let me tell you, we are sitting in India, we are studying accounting, companies are doing accounting, right? Even the companies in US, maybe in New Zealand, or maybe in Australia, or maybe Europe, right? Accounting rules, regulations are universal. What is to be debited in India, it has to be debited, it will be debited in US or any other part of the world. If assets are debited, assets are debited. They have a debit balance, they will always have a debit balance. Right? Is it okay? The non-commerce will not understand this right now, but remember, whatever accounting we are doing in India as per the rules, those rules are also applicable, universally applicable. They are not different. They are not different. So financial accounting is constrained by GAAP, but management accounting is not constrained by GAAP. Why it is not constrained by GAAP? Because in management accounting there are no rules and regulations. Maybe tomorrow, maybe she's a CEO of an organization, right? And I'm the finance manager. So she would like to know, okay, tell me, Rishi, who are the debt? How much we have to collect from our debtors? So give me the debtors list. Now that is her company, and she would like to know the list of the debtors and how much money we have to receive from the debtors. This is her company specification. Now he is again a CEO of an organization, and I'm a finance manager. He asks, okay, how much payment we have to make to the creditors? Give me the creditors list, right? Okay, he is again a CEO of an organization. He asks, okay, finance manager Rishi Thaparia, give me how much we owe to bank and financial institution, right? Okay, he is another CEO. He says, okay, we have to expand our business, so we have to make a project report. Give me all this information. Now, understand, 4 companies, 4 different requirements. So the requirements vary. So that is what we call management accounting. It is not constrained by GAAP. Every company who is doing business, whatever information they want from the account department is very specific. It is very, very different. It is not same. Is it okay? Number 1. Number 2, financial accounting information is used by external as well as internal users. Like I said, company when they make financial statements, those financial statements are basically for the users of accounting information. When I say users, those users could be internal users or external users. Yes, those users could be external or internal. When I say external or internal, for internal, when I talk about internal, we have owners, we have management, right? We have employees. These are the people who are internal to the organization. They need accounting information, right? When I talk about external, who could be the external bodies? Could be banks, financial institutions, right? Private lenders, public, or you can call them investors, government, okay, fine. Okay, we can call it taxing authorities. When I say taxing authorities, I am talking about income tax, GST, service tax, maybe custom and all that, right? Okay. Then you have Department of Company Affairs, Department of Economic Affairs, clear? Then you have media, then you have debtors, creditors, right? And then you have, let's say, researchers or scholars like us. So they all need accounting information, clear? Whereas management accounting information is only needed by the internal people, no external people. We both work in the same organization, If she is asking for some information, why he will be interested? Because he is not a part to the organization. Is it okay? Clear? Third, financial accounting is historical in nature. It is past oriented. Whatever we have done in last one financial year, financial accounting, like I said, recording, classifying, summarizing. So whatever we have done in last one year, it is summarized. It is summarized. Is it okay? Right? So it is always historical in nature. Whereas management accounting is future oriented. So based on what we have done in the last 1 year, considering it, the company takes a lot of management decisions. Now what could be those management decisions? Okay, fine. Investment decision is one management decision, right? Capital budgeting we call it, whether to purchase a plant or machinery or not, how much we have to invest in research and development or not, right? Whether to go for diversification or not, whether to go for disinvestment or not. right? Whether to which sales campaign we need to use to increase the sales of the company, right? Clear? So there are lot of things the company would take, and but remember, they are all investment decision. Another is financing decision, right? Again, when I say financing decision, whether we should go for IPO or not, whether we should go to bank to take loan or not, whether in case if we are going for IPO, should we go for equity or we should go for debentures, right? This is again a financing decision, or whether we should go for a working capital loan or not, it is again a financing decision. Clear? Third most important thing is what you call is a working capital management decision. Again, this is an important decision for a company to know. Working capital, when I say working capital management decision means the lot of components on which the company has to decide. Something like, let's say for example, cash management. It is a decision making. How much cash the company need to keep as a cushion, right? And how much cash the company need to invest. There are a lot of companies, they have lot of cash with them. But what to do with that cash? Should we keep it in tijori or safe, or should we invest it? Absolutely. When we invest money, we get more returns on it rather than keeping it in a locker. It will remain, you keep it for 100 years, it will remain safe. Clear? So that is cash management. So we have to manage our cash so that we are able to increase it more. Another is receivables management. When I say receivables management, this is again a decision. Every company has a credit policy. Every company has a credit policy depending upon the size of the nature of the business. Some of them they take advance, some of them they will pay them in 30 days, in 45 days. When we book a ticket, train ticket, and we have to pay to IRCTC, it is something like we book a ticket free and we can pay later to IRCTC? No. Before we take the journey, we have to buy a ticket and we pay immediately. Whether we take the journey or not, that is immaterial, that is secondary. So the money has gone out from our pocket. Clear? So it depends upon the nature of the business. So receivables management is very important. Every company would not like to have debtors who do not pay them back. Are you getting my point? Yes. So every company would like to have those debtors who pay them within their given time period. If you have given them a credit of 30 days, you should be able to get the money within 30 days. Is it okay? Right? So that receivable management is another decision making which a company has to take, right? And so on. Again, third most important one I forgot, inventory management. Inventory need to be managed properly. Let me tell you, company make product not for themselves. They do not make it to store it in the warehouse or in the godowns of the company. They would like to sell it, right? So inventory need to be managed. And let me tell you, 70% of the total working capital is again invested in inventory. Clear? Right? So what Amazon is doing, it is an e-commerce business, right? Do you think that they just buy one television? If you place an order, they will buy it from the company and give it to you? No. They buy in bulk. And that is the reason 100 rupee product cost come down to maybe 40 rupees because they are buying it bulk. That is what we call a trade discount. That is what we call trade discount. There are two types of discount. One is a cash discount, another is a trade discount. Cash discount is given for prompt payment. Prompt payment means I have sold to her. I said, ma'am, this is 100 rupees. If you make the payment immediately, I'll give it to you 90 rupees. Clear? So I'm giving her 10 rupees discount. But if she says, I would like to buy 100 shirts of this, I said, okay, fine. If he buys one shirt, will I be giving the same discount to? No. So trade discount is always given on bulk. Cash discount is always given on prompt payment. Trade discount is not recorded. Cash discount is recorded. Is it okay? Clear? Eh? Understood. Okay. So, what happened? Oh, I believe the system has gone, battery has gone. I charged it, he said that he will arrange the extension and all. All right. So, financial accounting. So, management accounting is future oriented. Financial accounting is past oriented. It is historical in nature. Financial accounting is usually for 1 year, and it is not flexible. It is not flexible. It is from 1st of April to 31st of March 20x2, and this time period is fixed. Management accounting is flexible in nature, very flexible in nature. It can be from 1 minute to 10 to 15 hours to whatever it is. She needs one information right now. She came back to me again. Rishi, after 2 hours, give me this information. After 2 hours, Rishi, I need this information too. And throughout the day, she is seeking information from me. Clear? So that is what management accounting is all about. Clear? So management accounting is very flexible. It varies from hourly to 10 to 15 years. Okay? Right? Financial accounting, it prepares financial statements. Like we have already seen that. And it is always made for the whole entity. It is not for one part of the business, not for the other part of business. Like I said, Hindustan Unilever is having, let's say, 5 soaps, A, B, C, D, E. Okay. Management accounting will do this individual decision. Cost accounting will be doing individually, but when we do financial accounting, we do it in totality. Let's say this is the total sales of the company: 100, 150, 120, 130, 140. So what we will do, we will add it, we will get the total sales. Right? Then we have total expenses. Let's say this is 80, this is 50, this is 70, this is 110, this is 100. Right? So what we will get, the total expenses. And then we will get the profit of a company. Total sales minus total expenses. Total sales minus total expenses, what we get the profit. So we are getting individual product wise profit also, and we are getting the in totality. So financial accounting, it does accounting in totality for the whole entity. But management accounting, it does for individual products, individual businesses of a company. So, management accounting prepare detailed reports and primarily concerned about the detailed parts of the entity, product, department, divisions, etc. etc. Clear? Financial accounting does not work on approximation, please. It does not work on approximation. Means no approximation. It has to be exact. It has to be exact. What do you mean by exact? For example, I say on 31st of March 2022, the company turnover is US dollar, let's say 150,789.99, for example. Can I say, okay, the company 31st March 2022, the company turnover was around $150,000? No, it has to be exact. If you multiply it by 80 rupee, you know how much it will be the difference. Clear? Whereas management accounting, we consider, she says, okay, tell me the sales figures. I'll say, ma'am, approximately 1,51,000. $1,51,000. It will work. Or I will say $1,50,000. It will also work. Clear? Because it is a management accounting. She's not going to ask me to hang, you have given me the wrong figure. Right? Clear? Understood? So that is what is the difference between the financial accounting and management accounting. Right. Now, like I said, we have to talk about more about GAAP, that is generally accepted accounting principles. Okay. Now, remember, accounting is the language of business, right? If you have to understand business, you should know accounting, let me tell you. This is very important. As an investor also, you should know about accounting a lot. Tomorrow, how many of you does not love money in this class? Who does not love money in this class? Everyone? Okay, great. If you love money, let me tell you, you need to understand the business very well. I'm giving you one very important thing today. If you really want to invest money, if you have, whatever you have, do not invest in the company. Do not invest in the company. I know I like Ratan Tata a lot, but doesn't mean that I have to invest in all Tata companies. companies. Clear? You have to invest in the business, not in the company. If you think that this business is going to flourish in the next 10 years from now, invest in that business. If you think that this business is not going to work in the next year or maybe next 5 years, it is collapsing, stop investing. So instead of investing money in business in the companies, invest money in the business. That's very important. Try to analyze which business is going to flourish in the next 10 years. Study it. See what are the initiatives taken by the government, which sector they are promoting, which sector they are getting, bringing investment from outside the world, or maybe the government investing in itself. Top up. See those industries, right? Like electric vehicle, another big thing which is going to happen. EV. Now, when I say electric vehicle, what all other industries are attached to it, they will grow. Are you getting my point?
Yes.
Another is IoT. Next big thing is happening in India after COVID, Internet of Things. So what all companies are going to, you can say, investing a lot of money in IoT and maybe becoming big in the next 5 years or 10 years from now. See that, those companies. Are you getting my point?
Yes.
Yeah. So instead of investing in companies, you should invest in businesses. Absolutely. Clear. So accounting is the language of business. If you have to understand business, you have to understand accounting things. Clear. Number two, to ensure that the language conveys the same meaning to all people. That is the reason. If plant and machine is an asset for me, it will be an asset for all of you. It cannot be liability for you. Clear? So it is conveying the same meaning to all the people. Accountants around the world have devised specific rules, procedures and conventions which is known as GAAP. Yes. Which represent a shared professional view of acceptable accounting practices. These are the acceptable accounting practices all over the world. Yes. Clear? Right? These principles, rules, they have been developed by various accounting bodies. They have been developed by accounting body. India में कौन सी है? Institute of Chartered Accountants of India, ICAI. They do a lot of work. They do a lot of work for in the field of accounting. Whatever rules, regulations have to be brought in, this body, it plays a very important role, right? And the primary goal of maintaining uniformity in accounting practices. Yes. Clear? And these rules and principles, they are imposed on companies so that investors have the greatest level of consistency in the financial statement they use when analyzing companies' financial records for investment purposes. Actually, ultimate accounting is done for users, investors. The companies are running business not because they have invested their money. No, it is the people's money which have been invested. So ultimately, whatever the company is doing, it has to be ethical. They have to abide all the rules, regulation, principle, procedures. Only then they can do accounting. Understood? Clear? Right. अभी लेनी है?
बच्चों की किताबें सेपरेट कर दी।
मैंने करा नहीं, अभी तक कर देता हूँ। अच्छा। Just write your number and signature.
सर आप अपना फिल कर लीजिए।
मैंने फिल कर दिया।
क्या हुआ है?
हाँ, ये ये
ठीक है। बाकी पैन कार्ड वगैरह आप ला
मैं ला दूँगा अगले नेक्स्ट क्लास में लाऊंगा। So understood these generally accepted accounting principles? Yes. Right. Remember always that whatever accounting principles are there, they are universally applicable, right? And they are basically for the users, right? The company they maintain, they make financial statement for the users, not for themselves. Okay. Let's talk more about GAAP, right? GAAP is developed by FASB. What is FASB? That is the Financial Accounting Standards Board, FASB, right? Now, the following GAAP principles can be discussed. Let us see. These are some principles, GAAP principles, which every company has to follow, right? The first principle is principle of consistency. Just to make you understand, consistency. Rahul Dravid, all of you know?
Yes, sir.
Right. The wall of Indian cricket team at one point of time, and he was considered to be a consistent batsman because he used to make consistent runs in almost all the innings in almost all the matches. Clear? So what we can say, okay, fine. Today, let's say for example, in one match he was out at 0, another match he made 30, in another match he made 20, another match he made 100. So the performance is not consistent.
Yes, sir.
Clear? So can you compare the performance of that individual? No. So comparison is only possible when there are consistent policies. Is it okay? So when I say consistent, just to take you one example, the commerce people would be able to understand right now that when I say consistency, I'm talking about certain, you can say, rules, regulations, right? They are followed from 1 year, or methods, they are followed from 1 year to another year. And the best example for consistency is methods of charging depreciation. Yes. I'll tell you what is depreciation later on. But non-commerce student, just to make you understand, it's simple, sir. Layman language. If I have to explain to a layman language what is depreciation, it is fall in the value of fixed asset. It is fall in the value of fixed asset. Let's say today you bought an iPhone, right? 30, maybe at around 90,000 bucks. Tomorrow you have iPhone 14. And you want to go for iPhone 14. And you want to sell your iPhone 13. Will you be able to sell it at its purchase price? No. You have used that machine, you have used that mobile phone. The value with the passage of time has gone down because there is a new product, new design, new technology available in the market. You will not get the same price. That is what we call depreciation. Right? So depreciation, this method, it has to be consistent. When I say consistent, means there are methods of charging depreciation, and there are two important methods of charging depreciation. One is what you call is a straight line method, and another one is a diminishing balance method. And this is also known as written down value method. Now remember, if a company is using this method, right, for charging depreciation on fixed asset, then this method should be used from 1 year to another year, so that the company can compare their fixed assets easily. They can draw some meaningful information from there. But for example, in 1 year the company charged this, in second year the company charged this, then they move down to this, then they move down to this. Is it possible to compare the value of fixed asset? No. That is what you call principle of consistency. Means this principle ensures that the organization use consistent standards while recording the business transactions. Right? Number 2 is principle of regularity. Now, principle of regularity means all accountants, they should abide the rules and regulations which have been framed by under GAAP, right? All the rules and regulations. The accountants, whatever accounting they will be doing, they have to do it as per GAAP, as per the accounting principles, rules and regulations. This is okay? Third, principle of sincerity. When I say sincerity, when people who are sincere, means sincere in the sense they do not bump like students, they need to be sincere. They are not bunking classes, they are on time, they are studying hard, so the result will be positive. Right? So sincerity means the accountant, they have, whatever accounting they are doing, they need to be sincere in that. Right? It's not that, okay, no accounting is done on whims and fancies of an accountant means. Well, okay, I have those bills, those numbers of bills, some of them I am passing journal entries, some of them I have parked in my drawer, and I'm not passing the recording those business transactions. So I'm not sincere. So if I'm not sincere as an accountant, do you think that the company will be able to portray the correct picture of an organization to the users of an accounting information? No, they will not be. So that is what you call principles of sincerity. The accountant need to be sincere. The accounts people need to be sincere. Right? So whatever business transactions are taking place, remember, they need to be recorded in a chronological order. When I say that they need to be recorded in a chronological order, means they need to be recorded date-wise. They need to be recorded date-wise. The transactions taking place on a day, let's say today, on 25th of December, any transaction taking place today, it should be recorded today itself. It cannot be recorded on 24th, it should not be recorded on 26th. That is what you mean. And if any transaction is taking place on 26th, you cannot record it in advance also. Understood? Clear? So that is what we call principle of sincerity. Another is principle of permanence of method. When I say permanence of method, it means whatever financial reporting the accountant would be doing, they have to follow the consistent practices and procedures. Clear? Right? Whatever it is. Permanence of method. Then principle of prudence. Prudence means the financial data need to be reasonable, it will need to be accurate, there should not be any biasness, there should not be any speculation. Remember, there is one convention of conservatism. I believe the commerce student would have studied. Convention of conservatism. What it says that anticipate profit, but make provision for all possible. Right. You can anticipate, but you cannot record that. For example, if I'm doing business, I can say, okay, if I do this transaction, I will have this profit. If I do this transaction, I will have this profit. But this cannot be recorded in business. But if I have sold goods to people, and if I expect that she does not have a good image in the business, in the market, and she is a defaulter, she will not pay me back, so that will lead to bad debt, right? So I will make all such provisions. So make provision for all possible losses. Is it okay? Right? So that is what I am trying to say here, is that principle of prudence here means that whatever data is available, it needs to be reasonable, it needs to be free from biasness, it needs to be factual, and there should not be any speculation. Why there should not be any speculation? Reason being is because this information is for the users. Always keep it in mind that it is the people's money invested in the company. Yes. Then principle of continuity. Principle of continuity states that the valuation of asset is based on the assumption that the business is continuing for a longer period of time, for an indefinite period of time. Is it okay? It's not that the company is doing business for a year or 2 years. It is for a longer period of time. Yes, that is what you call and there is a concept also. We will talk about this concept later on. There is a going concern concept. What it says is that when company is established, they are doing business for a longer period for an indefinite period of time. Right? Next, principle of materiality. What it says, material. Material means relevant, important. All relevant, all important information need to be furnished, need to be a part of the financial accounting, need to be a part of your financial statement. All material and important information. So what it says, that this principle, it emphasizes on the full disclosure of true financial position of the business. That is what you call the principle of materiality. Then there is a principle of periodicity. When I say periodicity, remember, the company that are maintaining these financial statements, they are doing this financial statement, they are doing this financial accounting, and they are doing it for this financial year. Now this financial year can be broken down. It can be broken down. Let's say for example, any company which is listed on a stock exchange, it is mandatory that they have to come with a half-yearly result. And these half-yearly results need to be published in a national newspaper. Absolutely, it is mandatory for them. So, but yes, accounting has to be done. So, periodicity means this principle states that business entities should abide by the commonly accepted accounting periods for financial reporting, such as half-yearly or yearly. Is it okay? But in management accounting, it can be done on our basis, hourly basis. It is not necessary, and it is not necessary to publish it in the newspaper, right? But in financial accounting, if the company is listed on a stock exchange, it is mandatory. ये तो पता है ना कितने स्टॉक एक्सचेंज है हमारे देश में? दो, BSE and NSE. Yes, great. Now another one is principle of non-compensation. This principle states that no business entity should pay compensation in return for providing accurate information in financial reporting. Is it okay? Right? Next is good faith. That's very important. The principle states that all parties which are involved in financial reporting, they should be honest in reporting the business transactions. Is it okay? So most of you are from studying this particular paper. Some of you would be joining Big Four of the Big Fours, and as a Big Four, you would be joining KPMG, EY, Deloitte, right, Gartner, or maybe any other company. Remember, you need to be ethical whenever you are doing business. Clear? That is very important. Whatever information you are furnishing it to the users of accounting information, it needs to be correct, true, unbiased, not speculative. So these are some of the gap principles which need to be considered when we do accounting. Yes. Now we are moving down to accounting principles. Now accounting principles establishes greater accountability and transparency in financial accounts. No principle means no accountability, no governance. Good governance we talk about, right? So that is something very important for a student to know, because in MBA, the most important paper which is taught in most of the B schools of the world is you can say corporate governance and ethics, and this comes in the final semester, right? Because before you enter into the corporate world, some of you would be working also, I believe so, right? So corporate governance and ethics is one such paper which is taught to every management branch. Whatever line you are into, whatever business you are into, right? You have to have that corporate governance and ethics. Right? You need to be ethical. So accounting principle, it brings a lot of accountability and transparency in financial statement. Clear? That is what happened with Satyam, right? And there's a scam in Satyam, and what happened? The owner he has to he has to surrender. Harshad Mehta case, Ketan Parekh, that is what has happened. They played with the accounting figures, right? And that is the reason they have to see them. And at one point of time, Harshad Mehta was driving in a driving seat, and he was driving the whole stock market, right? But what happened to him?
विंडो ड्रेसिंग तो कंपनी
करती है, लेकिन करना नहीं चाहिए.
गाइडलाइन होनी चाहिए.
हाँ, लेकिन अभी the rules they have become very strict and stringent now.
फिर भी सर 10%
करते हैं, मैं मना नहीं कर रहा. करते तो हैं, लेकिन मना नहीं कर रहा. लेकिन मैं आपको ये सिखा रहा हूँ कि नहीं करना चाहिए. I'm teaching you नहीं करना चाहिए. Clear? Right. करते तो सभी कुछ है, लेकिन हमारा एज ए टीचर पढ़ाना का फर्ज बनता है कि आपको ये नहीं करना चाहिए. Clear? So accounting principles can be classified into two categories. One is a concept, another is a conventions. Right. So concepts means basic assumptions or conditions upon which the science of accounting is based, right? Or the rules that should be followed in the preparation of all accounts and financial statements. Very clear. This we have talked about. Conventions, again, they are the guidelines, right? And that guide accountant while preparing accounting statement. Clear? These are the, you can say, practices which are generally accepted by almost all the organizations in the world. They cover wide range of issues, how to handle issues, situations ethically, what measures need to be taken when you face any such specific issues, how to report and disclose certain sensitive information. So, for example, the example for a convention is debit is on the left hand side, credit is on the right hand side. This is an example of convention. Let's see more further. Let us see the difference between concept and convention. You will be able to understand more. Let's see the difference. Concept and convention. The meaning: concepts are assumptions, they are notions, or conventions are practices. They are traditions or practices. Whatever, since the day accounting has started, no doubt the way of doing or presenting the information has changed. But whatever is debited at that point of time is debited today also. Whatever is credited at that point of time, it is credited today also. But presentation of information, maybe it has become different. Companies Act 2013 has completely changed the way the financial statement need to be presented. Alright? It is just the way of presenting the information. Otherwise, everything is remained same. Help in formulation of accounting methods. And whatever accounting method has been formulated, conventions help in applying them. Yes, it is in application of accounting methods. Judgment. In concepts, there are no personal judgment. It is framed. They are all assumptions, notions. So there is no personal judgment. ये सही है या ये गलत है. But in conventions, there are personal judgment. ये ऐसा होना चाहिए था, like you said. ऐसा होना चाहिए. ये कर सकते हैं. ये हो सकता है. Right? इसको इस तरीके से कर लेते हैं. वो वहाँ हो सकता है. Develop. Concepts are developed by accounting bodies, like ICAI. Clear? Whereas conventions, they are developed through common practices. When we actually do, then we come to know, okay, fine, this can be done in this manner, and then it becomes a rule. Right? Uniform. It is uniform all across the entities in the world, in the country. Right? Right from a small shop to a big business house. Whereas when we talk about conventions, they need not be uniform. It is not necessary to be same. With the passage of time, they get changed. We can revamp them. We can change them. We can amend them. So conventions can be amended. Concepts cannot be amended. They are uniform. Recorded. Concepts are officially recorded, whereas conventions, they are not recorded officially and are followed as generally accepted guidelines. Is it okay? There's a basic difference between concepts and conventions. Is it clear? Understood? Right. So let's move down to some accounting concepts. Right? So there are various accounting concepts that are followed by accountants while maintaining financial statement, and these are some accounting concepts: business entity concept, money measurement, going concern, cost concept, dual aspect, accounting period, right, matching concept, realization. Okay. So let's start with the first one. Business entity concept, right? There is another word for business entity concept. We call it separate entity concept. Very simple is that a business and businessman are two separate and distinct entities. They are not same. Business and businessman are two separate and distinct entities. Let's say, for example, Rishi Thaparia and Thaparia Tools Limited, for example. Are they same or they are different? They are different. Yes. So he's an individual. This is a limited company. May be listed, may not be listed. Okay. So he is what we call is a sole proprietor. We call it individual, and any individual who is running a business, we call it sole proprietor. So this is one form of organization. This is one form of organization I'm talking about. So now we are talking about forms of organization here. There are three forms of organization. Three forms of organization. Sole proprietorship, another one is a partnership, and the third one is what you call is a joint stock company. Joint stock company, or we call it limited companies. Public limited companies. There are others also, but primarily we talk about these three. There is the HUF also, Hindu Undivided Family also is there. Clear? So these are the forms of organization, and all these forms of organization have their own features. They have all positives and negatives. Is it okay? So as far as business entity concept, what it says that business and businessmen are two separate and distinct entities. They are not same. So when I say this, there are certain things which you need to understand. What is most important is that this company is basically different from sole proprietorship. Clear? Now, what is the difference? Here, the investors have invested money in a company. Investors have invested. Now, there are many investors. Clear? So, when I say many investors are, so all these investors have invested to the tune of their, you can say, as per their capability, they have invested. Let's say some of them would have invested 500 rupees in a company, some would have invested 1,000, 10,000, right? A lakh rupees or a 10 lakh rupees, for example, let's say. These are the people who have invested money. Now, this company has a liability. This company has a liability. And this company has a liability, let's say, 20 crores liability on banks and financial institutions to pay. Clear? Now, here, what happened in this limited company is that these individuals who have invested money in a company, their liability is only the tune of the money they have invested in the company. For example, a person who has, or an investor who has invested 500, the company cannot ask, bhai sahab, we have to pay 20 crore, pay this much of money to us. No. Their liability is only to the tune of the money they have invested in the company. So what I am trying to say here is that, okay, if this is the case, here liability is unlimited. Here liability is unlimited. But in case of company, the liability is limited. Yes. Is it okay? It is limited. If a company has a liability, then investors, the people who have invested money in a company, their liability is only to the tune of the money they have invested. That's it.
Yes,
The company is not going to ask the investor. अब विजय माल्या के 7,500 करोड़ रुपए कंपनी को देने हैं मान लो, तो क्या बैंक जो है सारे इन्वेस्टर्स शेयर होल्डर्स के पास चले जाए कि ओ फाइन योर मनी पे दिस मनी टू अस? No, they cannot do that. They cannot do that. So there is a unlimited liability, there is a limited liability. Secrecy is very high here. What I am doing, you guys will not be able to know in my business. Whether it is true, whether it is correct, whether it is unfair, whether it is unethical, you guys will not be able to know. Only I will be able to know. Who are my creditors, who are my suppliers, who are my customers. Only I will be able to know. You do not know. But any company which is listed, it is mandatory for a company to declare everything.
Yes, sir.
Because transparency is important. Transparency is important in case of public limited company. Right? So the company which is listed, it has to be transparent. It has to be transparent. का मतलब है दूर पारदर्शी होना चाहिए. It means the company should be able to, in their annual general meeting, they should be disclose everything to the shareholders of the company. This is what we are doing. This is what we have done. This is what we expect to do in the coming year. These are our business plans. These are our expansion plans. So business entity concept का मतलब होता है कि business and the businessman are two separate and distinct entities. Is it okay? The only exception is absolutely. This is an exception. Here, in sole proprietorship, Rishi Thaparia and Sons, they are same. Is it okay? Clear? Understood? Okay. Next is money measurement concept. Money measurement. Like I said, in the definition of accounting, you have seen in terms of money. What we saw there is that all business transactions need to be in money terms. It needs to be expressed in terms of money. So what money measurement concept says that all business transactions which can be expressed in terms of money should be recorded. It should be recorded. Is it okay? Understood? Any business transaction which is of qualitative in nature should not be recorded in business. Clear? So to record a business transaction, there is a common measuring unit. There is a common measuring unit. What is the common measuring unit in India? Rupee, yes. In US, it is US dollar. In Australia, it is Australian dollar. So for example, if I would like to know a company is having, let's say, 10 acres of land. 10 acres of land. They have 5 plant and machinery. They have 20 motor cars, right? They have, let's say, 10,000 metric tons of raw material, right? They have 20 lakh cash, right? If I would like to know the total assets of a company, can you give it? No. Unless until you cannot convert them into rupee. So all these transactions need to be converted into rupee. Only then you will come to know that these are the total assets of a company. Is it okay? That is what you call money measurement concept. Is it okay? Third, going concern. Going concern means that every business transaction, right, doing business is doing it for a longer period of time. So when we talk about a company, company is an artificial person. Company is an artificial person which is created by a group of people. Is it okay? And we expect that company has a perpetual life. We always expect company has unless until the company gets into liquidation and winding up of operations. A company says we declare ourselves, we would like to wind up the operation, we would like to close the business, then it is okay. Otherwise, when a company is established, it is established for an indefinite period. Even if the company is not producing any commodity. Even if the company is not producing any commodity, company exists on paper and it will continue to exist till the time the company does not say that they are winding up the operations, they are closing down their operations and they are closing down their business. So going concern means the company keeps on going for a longer period of time or for an indefinite period of time. Is it clear? Understood? There are a lot of companies which are not doing anything these days. They are closed, but still they exist on paper. Yes, they are not dead. Clear? Fourth one, cost concept. What is cost concept? Cost concept says is that, okay, what is the cost? What is the cost according to you? Price to pay. Yeah, okay, fine. So she said it is an acquisition price. It is an acquisition price, means price which we have paid to acquire something. That is what we call a cost. Whether you purchase a shirt, whether you purchase a plant and machinery, or an airplane or a pen, it is the price which has paid. So it is a cost. So according to the cost concept, as per this cost concept, what it says is the fixed asset purchased, right, should be recorded at its purchase price in the books of account, not at the market value. Is it okay? Is it okay? It should be recorded at its purchase price. Let's say, for example, I started business way back in 1970 and I bought a piece of land. I just paid 10,000 rupees to acquire that land. Now, after almost how many years? 52 years, right? This land, it costs now 100 crores. It costs now 100 crores. Now, tell me, in balance sheet, should I show it at 10,000 or should I show actually at 100 crores? 10,000. Right. No, point is that I have not invested 100 crores to buy that land. I have just paid 10,000 rupees. No doubt its valuation is 100 crores. But yes, there is a rule that you can show it at its market value, but you have to declare it in the notes to account that this land it is shown at its market value, not at its purchase price, so that the investors actually should know that you have not invested 100 crore to acquire this land, you have invested 10,000. Is it okay? Because we would like to give the true and fair picture to our investors. Is it okay? Clear? So what is cost concept? Whatever asset we have purchased, we have to show it at its purchase price, not at its market value. Is it okay? Clear? Another one is a dual aspect concept. Dual aspect concept. Okay. Dual means two. Okay. Dual means two. For every business transaction, there will be two aspects. One is debit and another is credit. Clear? For every business transaction, there are two aspects, debit and credit. So here let us talk about an accounting equation. A bit about accounting equation. Right? So what is an accounting equation? It says assets is equal to liabilities plus owner's equity. Broadly it is like this. Broadly, if you see, any accounting equation will look like this, that assets is equal to liabilities plus owner's equity. We will talk about asset, liability, owner's equity later on. Right? But this is an accounting equation. So this is my left hand side and this is my right hand. And this left hand side and right hand side has to be equal in all aspects in every business transaction. अगर 100 रुपए इधर है तो 100 रुपए इधर होंगे, 200 रुपए इधर है तो 200 रुपए इधर होंगे. Clear? Now, we can further expand it, right? Assets is equal to liabilities plus owner's equity plus revenue minus expenses. Clear? Or we can rewrite this as asset is equal to liabilities plus owner's equity plus minus profit oblique loss. The question here arises for non-commercial, profit kahan se aa gaya, loss kahan se aa gaya, right? So here what we talked about, revenue and expenses, right? This duster, it cost less than 10 rupees. That's the CP, cost price of a duster, and I sold this duster at 12 rupees. So there is a profit of 2 rupees. If I sold this at 9 rupees, there is a loss of 1 rupee. That is. So what I am trying to do here is that we have added profit if there is a profit, and we will subtract loss if there is a loss. Is it okay? Clear? I am not getting into further why we add profit, why we are subtracting loss, or what increases capital, what decreases capital. I am not getting. We will talk it later on. So dual aspect is clear that every business transaction, it has two aspects. One is debit, another is credit. For every business transaction, there are two aspects. Next is what you call an accounting period concept. This is what we have studied also. Accounting period concept means that in a business, there is an accounting period, and this accounting period is fixed. That is from 1st of April to 31st of March. In this one financial year, 365 days, whatever is done in a business, right, it has to be recorded. It has to be a part. It has to be included. Is it okay? Anything before that, anything after that, or means which does not belong to that financial year should not be recorded in that financial year. Is it okay? Clear? Abhi kaun sa financial year hai? 1st of April 2022 to 31st of March 2023. So whatever is happening in a company in this one financial year, it has to be recorded in this one financial year. Clear? Understood? Right. Matching concept. This is very important. Matching concept. In one financial year, company is selling product or they are rendering service. But to sell product or to render service, they are simultaneously incurring a lot of expenses. They are incurring expenses. Remember, revenue is earned, expenses are incurred. Absolutely. Right? Now what happened when company incur expense? So there has to be matching. There has to be matching. What is to be matched? We have to match the revenue and Expenses. Because expenses are incurred to generate revenue. Expenses are incurred to generate revenue. Is it okay? So that is what we call a matching concept. That in this concept, the expenses need to be matched with the revenue earned in one financial year. We cannot consider, for example, if company is paying salary to their employee for 2022 to 2023, whatever revenue has been generated by employee, it has to be matched with that. It cannot be matched with the next year sales, please. Next year revenue or the previous year revenue. Is it okay? Clear? Eh? Next is a realization concept. Like I said, cash system and another was there are two systems of accounting. There are two systems of accounting, cash system of accounting and accrual system of accounting. I'll talk it later, but let me tell you, the name says cash system of accounting, only cash transactions are recorded. Whether we pay cash or whether we receive cash, only those transactions will be recorded. But in accrual means credit. Accrual means credit. So when I say accrual, it means that the moment we sell a product, the moment we render the services, it has to be recorded. It is immaterial whether cash is received or not. Similarly, in case of expenses, right? It is immaterial whether cash is paid or not. The moment it is incurred, it is to be recorded. That is what you call a realization concept. Is it okay? Means realization means the moment, what I am trying to, this is not, under realization concept, what it means, the moment the company sell a product or render service, you need to book it, you need to record it. It is immaterial whether money is received or not. Is it okay? An accrual concept means everything is on credit, whether you pay money or not, but the moment the expenses are incurred, it has to be recorded. Whether you receive money or not, the moment you sell a product or render service, it has to be recorded. Is it okay? So just to make you understand, let me make a small matrix for you. Revenue is considered the moment cash is received, right? It is considered the moment cash is paid. That is under cash system of accounting. So it only considered cash transactions. No credit transactions are considered in cash system of accounting. Whereas in accrual system, revenue is considered the moment goods are sold or services are rendered. Services are rendered. Is it okay? It is immaterial whether cash is received or not. And it is considered the moment the expenses are incurred. It is immaterial whether cash is paid or not. That is the difference between cash system of accounting and accrual system of accounting. Is it okay? Is it clear? Now these are the concepts. So business entities, money measurement, going concern, cost, dual, accounting period, matching, realization and accrual. If you see this is just a small way that it has been presented. Clear? Alright, this is what we have spoken about. Everything we have spoken about. Clear? Okay. Now we are moving down to accounting conventions. Clear? 4 conventions are there. Convention of consistency, convention of full disclosure, convention of materiality, and conservatism. Convention of conservatism. Consistency means whatever method, accounting method we are using in one financial year should be used from one financial year to another financial year so that meaningful information can be drawn from it. Is it okay? And to give you an example, I gave you an example of depreciation. Method of charging depreciation, right? And there are 2 methods which we talked about: straight line method and WDV method, written down value method, or we also call it diminishing balance method. These are the 2 methods. If a company is using SLM method to charge depreciation on fixed asset, then this method should be used from one financial year to another financial year, so that the company should be able to compare the value of their fixed assets. Is it okay? If a company is using this method, it should be used for one year, but it does not mean that the company cannot change the method. The company can change the method of charging depreciation, but they have to disclose it in the notes to accounts that the company has changed the method of charging depreciation on fixed asset from SLM to WDV, or from WDV to SLM. Yes, clear. There's another example which we can talk about in terms of consistency is inventory valuation. Inventory valuation. Now there are methods to value inventory, right? There are broadly, if you see, there are many methods. The most important methods are FIFO, LIFO, and weighted average price method. Weighted average price method. These are the 3 important methods of valuing inventory. First in, first out, last in, first out, and weighted average price method. Right? If a company is using to value inventory FIFO method, then this method should be used from one financial year to another, so that it is easy for company to compare the inventory figures. But if a company change the, you can say, method, then it would be very difficult for the company to draw a meaningful information. Full disclosure. What is full disclosure? Full disclosure means the listed company should not hide anything. Should not hide anything. There should be transparency. Right? So whatever information which is relevant for the people to know, for the bodies to know, they need to be fully disclosed. They need to be fully disclosed. That's important. So transparency is the most important thing here. Company need to be transparent. Company need to disclose all pertinent, relevant information to the users of accounting information. Conservatism. Now, conservatism, if we talk about, I would like to say it is a policy of playing safe. It is a policy of playing safe. So, if a match is there and it is the, let's say, 9 wickets down and the last mandatory 20 overs need to be bowled, rather than hitting, right, it is better to play safe and take the team to draw the match. Is it okay? It is a policy of playing safe. That is what you call conservatism. So we need to be conservative in our approach. So what it says that do not anticipate gains. Do not anticipate gains, but make provision for all possible losses. This is the mantra of this. Do not anticipate gains, right? But make provisions for all possible losses. This is what you call the convention of conservatism. Convention of conservatism. Is it okay? Clear? It's a policy of playing safe. Like you were talking about window dressing. Here it comes window dressing. Alright? Okay? Right. And then materiality. So like fully disclosure, I said all pertinent, relevant information need to be fully disclosed. So materiality means all material information, all relevant information, all meaningful information, right, need to be fully shared with the users of accounting information. Nothing should be hidden. Nothing should be hidden. Clear? Transparency has to be there. Understood? Clear? Alright. What is the time by your watch? Time हो गया क्या? So we विश्राम देंगे यहाँ पे. Right? I hope you have understood something. Right? And my simple submission to all of you is whatever we have discussed. At least just give an hour to read it from book, right? It will anything which is not clear, right? We can talk 5 minutes in the next class. The P hoga, right? We will talk about those doubts, and we would like to clear those doubts. And in case if you have any issue, right? This is my number. All right, you can always drop in the SMS, right? But SMS mat bhejte rehna. Right? Any problem if you have, right? You can always just say SOL student, sir. Yeah, that is how I will be able to make it up, right? Yeah. So any issue you have in anything which you have not understood, we will talk it later. I believe the attendance is done. Anyone who has pardon? Writer तो आपको study material तो मिल गया ना? Got that? Study what I will do, I will share this PPT with you. Number 1, you have this study material. Number 2, you will have the question bank also, right? And apart from that, accounting you study from any book. It is just accounting, right? So yeah.